Welcome to today's webinar, Alternative Investments Industry Insights. Thank you for registering, and I wanted to tell you to register for upcoming AI Insight events and other industry events. Visit the News and Events section on AIinsight.com. To view our past events, go to the webinar and podcast page on AIinsight.com. Now I'll introduce Laura Sexton, Senior Director of Program Management. Laura?
Thanks, Jen, and thanks to everyone for listening in this afternoon. Before I get started on giving an industry update, I wanted to mention a couple quick things. So all of our data that we're going to cover in this webinar comes directly from the fund level data that's on our platform. So the industry reports and kind of the industry information I'm going to be talking about are an aggregate view of some of the key data points on all the funds that we cover, which all come directly from public filings, offering documents, and supplements that our analysts cull through. So having been an analyst before and having to have searched for data in different places, I just wanted to show you where our subscribers to our platform can find some of the data in the platform that's helpful for analysts and advisors, not only for due diligence reviews, but I would say also for sourcing new ideas, comparing different strategies, and things like that that I know as a former analyst would be helpful. So here you see circled our financial performance reporting section, which is where we report on the publicly registered funds that file on a regular basis, the non-traded type of funds. So it's where you can find the industry reports and where you can create custom charts, spreadsheets, and alerts. I think alerts is another one. When key metrics have changed by a certain amount, you can customize this. It's something I would have liked to have as an analyst. Definitely important for advisors if you want to be notified if anything changes with the funds that you have exposure to in your book of business and things like that. So in this case, I circled this, and then in this case we're going to just look at if you wanted to select a non-traded REIT to review. Again, for subscribers, you can see here you can look at several different data points related to the funds that you select. For an example here, I chose to look at the debt ratio, so I can look at debt trends. And in terms of output, you can look at it as a chart, or you can export the data to Excel and then create your own charts. And again, you know, here's a few examples of the output. Again, it's good for looking at individual funds, but also you can select multiple funds, and then you can compare as many funds as you need for these types of reports. So simple, easy, right here in an efficient way. The other thing that I wanted to show you is the Comparative Report section, which is where you can find data on all the funds on our platform that you have access to, which is different for everyone, customized for everyone. But this area includes all the private placements we cover, and is great for sourcing and comparing. So let's say in this case I want to review Opportunity Zone funds. This is where you can select the characteristics you want to review. There's over 200 data points you can create and export charts or spreadsheets directly from here. And as the case with Opportunity Zones, you can then diligence and analyze the different options efficiently to really determine which ones you want to take a deeper dive on. It's a really efficient way to get started on your due diligence and compare different options. You can also request due diligence reports from the law firms that out there directly from our site for those that are available. And finally, as I mentioned before, all of the industry data that I'll be discussing on this call came from our industry reports, which our subscribers who have access to financial performance reporting can find in the industry report section. It's in different places for different subscribers depending on who you are. For sponsors on the call, this would be under the programs icon. So again, just kind of wanted to mention that all the data here is all based on the information that we follow and the funds that we cover on our platform and with our analysts. So moving on to our update here, as an agenda, we're going to look at private placements, non-traded REITs, interval funds, and non-traded BDCs. So starting with private placements, I'll just cover a couple of the areas. We cover a lot of different areas in private placements. I'm going to cover a few of them here. But in terms of overall trends in the private placements we cover, new coverage for the year, not surprisingly, is down, meaning that we've added fewer funds this year than last. Through September 30th, we added 102 new private placements, which is 11% fewer year over year. And those funds had an aggregate target raise of $4.6 billion, which is down 28% year over year. And I'm sorry, that's August 31st, not September 30th. So through August 31st, we've added 102 new private placements. And I think September's data is probably going to be relatively similar, that we're down a little bit. Our private placement coverage is definitely weighted towards real estate, which is about 73% of the funds we cover are real estate. And in terms of objectives, we definitely have kind of a orientation towards income. That's the top category at 52% of the funds that we cover, followed by growth and growth and income objectives, 52%, 29%, and 18%, respectively. When we look at capital raise for funds that closed offerings this year, 109 private placements have closed in 2020. They reported that they raised 64% of their target and were on the market for an average of 342 days. 67% of the funds that closed met or exceeded their targets. This is just a little bit below last year. We were around 70%. Funds had raised about 70% of their targets. It's a little bit less in terms of the raise compared to target. 5 private placements did suspend offerings due to COVID-19 uncertainties. So a couple of the sectors, we'll start with 1031s, which had been experiencing record growth prior to COVID-19. Trends here in terms of new funds and targets definitely well below 2019 year over year. In terms of new funds added, down 17%, and target raised down 33%. Funds added recently definitely targeting less capital than pre-COVID-19. I think that has to do a little bit with the lending market. It's a little harder to get bigger loans. So you've got smaller programs being added. The funds on our platform are still meeting their target. So 9 1031s closed in August and 66 have closed so far in 2020. Those funds were on the market for an average of 274 days, and all but 3 funds that closed met or exceeded their target. Of course, 1031s are on the political agenda. They've been there before, but we'll see what happens. You know, always things to watch within this category. A few other trends, year one cash flow of 5.38%, down slightly from the prior months, but pretty stable, unchanged from last year. Average LTV 59.9, slightly higher than 2019 levels. The category remains weighted towards multifamily. Roughly half the funds with available capital are focused on multifamily, but we have had some kind of more diversified recent additions, including some self-storage, some net lease, and some medical office. And the average upfront selling commission for the 1031s we cover is 5.89%, and average net proceeds is 90.24%. So we talked about opportunity zones a little before. I'm looking at a few of the trends here. Another area that, despite some adjusted guidance from the SEC, the industry is down in terms of new fund added. We've added 8 so far in 2020. That's pretty significantly down, especially in the target raise, which is off by 70% from last year. In terms of what we cover now, there are 18 opportunity zone funds that we currently cover that have capital available. They have raised an aggregate $2.1 billion, or they have an aggregate target raise of $2.1 billion, and they've reported that they've raised about $860 million. This leaves about $1.2 billion in available equity, which is down from July and August in terms of capital still available. Sector and geographic focus here varies very widely, from very specific to broad, blind pool, national. One of the energy-focused funds that was on the platform closed in April. They raised about 22% of their target, but pulled it off based on what was happening in the economy. 5 other qualified opportunity zone funds closed in 2020. 3 of the 5 raised 100% of their target. 1 raised 39% of its target, and 1 larger fund actually exited the market before really raising any significant amount of capital. So again, that's not all those sectors we cover for private placements. You can check out our industry reports for more information on energy, private equity and debt, hedge funds, and futures. But I'll talk just a little bit about some of the market trends we're seeing. We do watch the markets. We cover the funds, and then we also watch the markets to see what's happening in the various markets that are impacting private placements. So some of the key themes in real estate include strong fundraising but low levels of transactions. So this is because there really isn't that much distress lately. People are kind of waiting. Bid-ask spreads are very wide, and there's just really some pockets of distress in hotel and retail. In this sector, there's been a pretty big consolidation to the larger, well-known managers. That's kind of happening all over the industry here. Transactions slowed 70% in the first half of the year in real estate. Economies are opening up, and cash flows are becoming a little more predictable, although we really don't know. So much uncertainty, but there's signs of pipelines picking up, so we'll see whether that transaction number ticks up a little bit. Similar to what we said in 1031s, many of the largest managers have met or exceeded fundraising targets, so there's still, transactions are down, but money is coming in. There's a record amount of dry powder in private real estate funds out there, kind of just waiting for pricing to kind of level out here. So in terms of hedge funds, they've largely recovered their early COVID-19 related losses. So Preqin's All Strategies hedge fund benchmark gained 3.29% in July, which brings the year-to-date performance to 2.88% as of the end of July. So, looking at some of the other indices, June, July, and August were all strong months for hedge funds, led by equity strategies, which is expected given the equity market rally. This year's been a pretty strong year for hedge funds overall. They've performed as they're supposed to. They've delivered both appropriate risk and returns. They've reduced correlation to the broader equity markets and had lower drawdown than when the markets were falling. So I think this kind of appropriate performance and risk mitigation may bode well for for future investment in the asset class. It's been a good year for that category altogether. Moving on, private debt markets definitely benefited from the lack of bank financing available to borrowers, similar to the Great Recession. I mean, non-bank lenders are in there once again, stepping in, using their kind of greater agility and speed to fill in the gaps. Energy sector, trade war impacts have definitely lessened. Pricing's actually recovered to about half of its pre-pandemic levels, although we haven't seen a lot of kind of activity on the energy sector on our platform. But oil is outperforming expectations of $34 a barrel by the end of the year. It's around $40 now. And according to Preqin, energy fundraising actually hit an all-time low in Q2 2020. That's kind of consistent with what we're seeing on our side. Investors are reducing their allocation to energy and looking at more alternative forms of energy. The outlook is positive as the supply side stabilizes and demand returns, although, as with everything, the duration of the pandemic is a key variable. All right, so moving on, I'm going to talk a little bit about some of the non-traded REIT trends that we're seeing. Q2 was definitely very slow, which was a combination of fears of what's happening and a few of the non-traded REITs pausing sales. Non-traded REITs raised $1.5 billion in Q2, which was one of the slowest quarters in the last few years. During the quarter, there were 11 perpetual life non-traded REITs, which are the daily, monthly, or quarterly non-traded REITs, and 9 life cycle REITs. Perpetual life REITs, definitely kind of the one raising the most capital. They raised 90% of the capital year to date, kind of continuing the trend towards the majority of the capital going to more of an open-ended type of fund structure. Looking at the year, non-traded REITs are still actually doing well because they had such a strong first quarter. They've raised $8.4 billion, which is ahead of 2019 due to that strong first quarter. Another trend that's continuing is that open non-traded REITs continue to increase as a percentage of raise, so meaning that this is new money coming in as opposed to distribution reinvestments. This is the highest percentage of money coming in from new programs since 2010. And Q3 initial reports indicate that sales have picked up again, so most likely will be a strong year despite that really weak Q2. Once again, the raise in Q2 was dominated by Blackstone. It's similar to what we've been seeing in other segments. There's certainly a concentration into managers that are well-known names. That REIT raised 75% of the raise year to date, which is actually up from 67% of the raise in 2019. Even more concentration. Not just to and again, this is not just to the largest and most well-known sponsors. It's a common theme. Not even just in COVID times, but the largest funds, the mega funds, actually, even before COVID-19, had been taking more and more percentage of capital on the institutional private placement side. So kind of continuing this trend even more so this year. And we're certainly seeing it in the non-traded REIT space. A couple of notable events, Carey Watermark Investors 2 merged with Carey Watermark Investors 1, and Rodin Global Property Trust closed, which was just closing their initial offering. They launched their follow-on, which is renamed Cantor Fitzgerald Income Trust. So as I mentioned, there were several non-traded REITs that have paused or suspended sales as they look to focus a little bit more on existing assets during this COVID-19 uncertainty. Of the 5, only Procontianti has opened back up, and you can see the list on AI Insight using the fund status update link on the homepage. We have the non-traded REITs, private placements, and non-traded BDCs listed there in the status based on what's going on with the markets. A few notes on financing. Open non-traded REITs reported 58% in fixed-rate debt and 42% in variable-rate debt. That's been pretty static for a while. Debt levels have been on the rise the last few years, down a little bit in Q2, 48% debt ratio for non-traded REITs. Just for comparison purposes, the FTSE Nareit equity index is at 31% debt ratio average. So this slide kind of shows how low interest rates are. They're at decade lows, and the prevailing thought is that they'll stay here for a while in the wake of COVID-19 uncertainty. So, a positive for the non-traded REIT side, at least a little bit here. In terms of distribution rates, open non-traded REIT distribution rates have held steady for open non-traded REITs, but are way down for closed, which don't have incoming capital necessarily, so they need to conserve cash flow a little bit more. For open REITs, the average distribution rate is 4.86%. Life cycle non-traded REITs are slightly higher at 5.02% and 4.78% for perpetual life non-traded REITs. Just for comparison purposes, again, the FTSE Nareit Equity REIT index pays an average distribution rate of 4.33%. In terms of AUM, despite the slow Q2, the industry is definitely on track to hit yet another record year in terms of AUM. Open non-traded REITs represent a greater percentage than ever before, which is a good sign for the industry. This is not just old money being recycled in distributions, it's new money coming in. The non-traded REIT industry represents about 9% of the $1.1 trillion traded REIT market. At one point it had hit 11% this year. It's kind of hovered around that percentage for a while, but once you're above 10, around the 9 to 10, 11%, it's something that the traded REIT markets take notice of. So it's definitely getting bigger as a percentage of that market. Total AUM still dominated by life cycle non-traded REITs, but this is really just due to the older generation, and it is shifting because 94% of the AUM of the open non-traded REITs is in perpetual life REITs. Core diversified represent the largest percentage overall, and life cycle REITs now tend to be a little bit more focused, while the perpetual open-ended funds are more diversified. It's kind of the trend we're seeing at this point. This slide shows the aggregate industry in terms of acquiring and selling assets. So in 2020, open non-traded REITs acquired 167 properties and have sold 9, well below 2019 year over year. Closed non-traded REITs acquired 67 properties and sold 64. So talking a little bit about returns, according to the Stanger REIT report, in Q2, perpetual life REITs returned 2.01% and life cycle REITs fell 2.9% over the 1 year annualized. The perpetual life REITs are 1.93% and life cycle REITs are down 0.95%. NAV REITs saw a bounce in NAVs in May and June to recover losses in May. I would say, life cycle REITs do tend to lag NAV REITs due to the relative illiquidity and kind of less active trading of the assets typically held by the life cycle REIts. Of the perpetual life non-traded REITs, Black Creek Diversified posted the highest 1 year return at 8.13%, while the Griffin Capital Essential Asset REIT posted the lowest at negative 1.66%. Returns within the life cycle non-traded REITs are typically more varied. Another industrial-focused REIT, the Industrial Property Trust, posted the highest 1 year at 14.33%, while RW Holdings Triple Net REIT posted a decline of 25.58%. The NCREIF Property Index actually turned negative in Q2. Very quick for this sector, I think really having to do with hotels, but the industry overall declined 0.99% due to a 2% loss in value offset by 1.01% growth in income. So on a 1 year basis, the overall index is still up 2.7%, but definitely a significant dispersion in returns among the sectors. And the hotel sector is down 18.1%, while industrial is up 10.3%. According to NCREIF, rents and NOI declined to historic lows in Q2, the lowest since NCREIF started reporting data ever in 1978. Hotel rents declined the most at negative 48.73%, followed by retail declining 12.68%. And even industrial, which has fared better through the downturn, saw rents decline by nearly 1%. NCREIF also reported a 70% decline in sales volume in Q2 year over year, with the lack of transactions making price discovery definitely very challenging. So another reason why we have that kind of slowdown in transactions and high bid-ask spread here. So now in terms of a market update for real estate, again, as we watch the markets related to the segments that we cover, some of the key trends we've been watching here. Obviously, we all know the economy is predicted to decline this year about 5%, even with improvements in Q3 and Q4, and that's hoping we have improvements in Q3 and Q4. No real estate sectors are going to escape the impact. No property sector is going to come out unscathed, even if there's some that are in better shape than others. I think it's interesting. One of the main things in real estate is that trends already in motion have been accelerated. And actually, I think there's a quote from Jones Lang LaSalle, a recent article from them that says it best, and I really like this one. The impact on commercial real estate is similar to the pandemic impact on individuals. Those with pre-existing conditions heading into the pandemic will likely fare worse, but for those in a healthier condition, they should weather the downturn relatively well. So, I mean, I think that kind of definitely sums up the situation with real estate. Those properties and assets that were in better condition and, better shape, kind of had better trends going, are in better shape, and those that aren't. It definitely makes sense. It's accelerated a lot of trends. On the brighter side, the real estate debt markets aren't throwing money at deals, but it's relatively healthy and functioning again in early Q3 after many lenders held out during the height of the pandemic. It's very different than the Great Recession, though, where the debt markets were totally frozen. CMBS delinquency rates up to 6.37% in June from 1.24% in March, kind of pre-pandemic. Actually up to 9.6% in July and then back down again to 9.02% in August, according to TREP and CBRE. Hotel and retail represent the largest percentage of loans past due. 25% of hotel loans and 17% of retail loans are in special servicing. Average LTVs for commercial loans fell in Q2. The underwriters were a little bit more focused on conservation and focused on the highest quality, lower levered deals. We'll switch a little bit to talking about some of the sectors, starting from the worst to the best. We'll get the bad news out of the way here. Not surprisingly, hotels fared the worst during this downturn with a direct correlation to economic health. CBRE overall occupancy declined 60.1 year over year in Q2. ADR fell 37.4 and RevPAR fell 75%, with some of the largest markets falling more than 90%. It makes sense the luxury sector suffered the worst, while the economy and mid-scale declined the least. And as I mentioned, according to NCREIF, hotel returns declined 16.09% in Q2 and 22% year-to-date. Next, looking at retail. Vacancy rates here up 200 basis points and rising and expected to peak at record levels in 2021 as a record number of stores are set to close in 2020, according to Cushman & Wakefield. Rents have already declined more than 2 times the amount of the GFC, and absorption was negative in Q2, the first decline since 2011. Clearly, e-commerce as a percentage of retail sales has been increasing over the last decade, but certainly kicked into high gear with COVID-19. As of the end of Q2, e-commerce represented 15.2% of total sales, up from 11.4% pre-COVID. And according to NCREIF, retail properties declined 3.85% in Q2 and down 5.6% year-to-date. Switching to office, the results here are definitely mixed. Vacancies up 200 basis points to 17%, and rents declined 6%, according to Jones Lang LaSalle. But development's definitely way down, and the trend towards densification has reversed course. I think everybody will have more of an opportunity to work from home, but I think a lot of people actually want to go back to the office after this. So, and when they do, companies are going to need a little more space per employee once things normalize, which helps offset some of the declines from remote working. Other trends here include a focus on shorter-term leases and a consolidation of space to more of like a hub satellite scenario where you have a main campus in a larger region that serves as a primary hub with smaller satellite locations that serve those employees who don't necessarily live in that hub. So really interesting trends. This is kind of positive for the secondary and tertiary market. They call them buzz cities. They've already kind of been gaining momentum from investors and seeing kind of people move out of kind of the big primary cities to what they call these buzz cities that are kind of absorbing some of that movement of people. So according to NCREIF, office returns declined 0.5% in Q2, but are still up 4% year-to-date. But this is likely due to the longer-term nature of office leasing. The sector tends to lag, so we could see some more declines here. And then we'll just talk briefly about the 2 sectors that have fared better, starting with apartments, which have held up relatively well in the first half of 2020. Given the severity of the downturn. According to REIT, vacancy actually remained unchanged in Q2 at 4.8% because people still need a place to live. And other positives include 60% reduction in new construction, continued eviction moratoriums, and the government stimulus package, which is obviously being reviewed again here. Rents are down. I mean, this makes sense. While vacancy was flat, effective rents declined. The first quarterly decline since the GFC, and some of the largest markets, including San Francisco, posted 3% plus declines in rent. So very different than prior to the downturn here. NCREIF reported a decline of 0.63% for apartments in Q2, although they're still up 3% year to date. And then the industrial sector, better positioned than others, but certainly not immune. I mean, international trade activity is down, and the construction boom over the last few years already impacted the sector. Construction definitely, quickly declined. It's the good thing for the good and bad thing for industrial is that you can very quickly ramp up or ramp down the supply chain. So it's very quickly ramped back down. Vacancy rates flattened in Q2 to 10.3 according to REIT, and asking and effective rent growth was also flat, kind of the weakest reading for this industry since 2011. Growth in e-commerce positions industrial probably is the best spot in the property markets for the foreseeable future. This is not well known. Everybody knows it. So, I mean, pricing is going to reflect that. This is not a surprise to anybody. So, pricing will reflect that. But, the supply chain is also being reanalyzed to have a more resilient and reactive supply chain. No one wants to run out of toilet paper anymore, ever again. So, the retailers are trying to consider whether they need to have more, warehouse space and a more resilient supply chain. And according to NREI, retailers need 3 times the amount of space for e-commerce as they do for brick-and-mortar business. So they need more industrial space if they're going to have a better, more resilient supply chain. According to NCREIF, industrial real estate returned 1.02% in Q2 and is up 10.3% year-to-date. The sector saw a very slight downtick in values in Q2, just offset by income returns of 1.09%. So we are going to shift over to interval funds and an update here. So as of the latest reporting periods for the interval funds, there are 66 active interval funds that manage approximately $29.4 billion in net assets. AUM for the interval fund industry declined 8% from the prior reporting period due to COVID-19 related losses. But of course, it's way up from even a couple years ago when we started following interval funds. There are about $19 billion in net assets there, and really largely concentrated in the top few. 6 new funds were declared effective in 2020, and there were 9 additional funds newly registered that are still in registration, including 1 BDC conversion and 5 very opportunistic funds. So I think it's interesting here, the first Bitcoin strategy interval fund was approved, ARCA U.S. Treasury Fund. So that's kind of a big statement for the cryptocurrency market. There have been a few of these that have been registered but none approved. So that's the first one. Should be interesting to watch that one. 1 private equity fund was approved that's focused on opportunities relative to the market decline. And Goldman Sachs acquired Resource Real Estate Diversified Income Fund. Although the merger with the Credit Income Fund was terminated, that fund will end up being managed by CR Crest, which manages a public BDC. In terms of the composition of the interval fund market, real estate surpassed derivatives and insurance-linked AUM for the first time at 32% of AUM. Credit and loan strategies actually represent half the number of funds, but only 19% of AUM. But I think with kind of that larger number of funds, we'll most likely see that increase over time. And the funds that have been taking in the most net assets recently are real estate, credit, and the alternative equity funds. They've all seen large inflows. In terms of sponsors, Stone Ridge was one of the first and the largest, but with new sponsors, their dominance definitely has declined. They're about 20% of net assets now versus 50% of net assets just back in 2016. Several large sponsors have entered the market, including, of course, Goldman Sachs and Nuveen. Looking at performance here, so average annual returns are down significantly for those funds that have reported recent semi-annual returns, which is about 56% of the funds. If you follow this segment, it's a little tricky because they all kind of report over different time periods. So the way that we report it, we look at those that have reported semi-annual returns and those that have reported their full fiscal year returns. So about 56% of the funds have reported semi-annual returns so far this year, and the average for those, the average return was negative 6.14%, but performance varies very widely at negative 32% up to positive 8.10%. The worst performing, not surprising, are the energy funds, and the top performing, also not surprising, was the alternative equity funds. So the funds reporting their fiscal year 2020 returns so far reported an average of negative 1.41%, so interestingly that's lower than the semi-annual, but this is somewhat misleading because funds with fiscal years, year ends earlier in the year reported higher fiscal year 2020 returns because they don't have the full impact of COVID-19 baked into them yet. So I think as we see more funds report their full year 2020 numbers, including those with later in the year fiscal year dates, we'll see that full year number decline since the mid-year semi-annual returns are so low. So switching now to the last segment, the non-traded BDCs. There were 4 open non-traded BDCs that raised $60 million in Q2, and they have raised $246 million year-to-date. This was the slowest quarter and year-to-date on record. There are a few notable events here, though. FSKKR Capital Corp. 2 listed on June 17th, so this was the combination of 4 prior non-traded BDCs, 3 of the FSIC funds, and CNL's Corporate Capital Trust. The combination was actually about 40% of the AUM of the non-traded BDC market, so it definitely brings AUM down quite a bit. However, interestingly, Blackstone filed a registration statement for a new non-traded BDC, which is the first since 2017, the Blackstone Private Credit Fund. So it'll be interesting to see if Blackstone can breathe some life into the category, kind of like they sort of re-sparked the non-traded REIT category. So that'll be interesting to follow. As you can see here this year, the capital raise is very much dominated by Owl Rock. They've raised a little over $225 million this year, followed by McKinsey, which has raised about 5% of that. The industry is still weighted to senior secured floating rate loans at about 82% of total AUM. This is a little higher than the direct lending markets. For comparison purposes, the Cliffwater BDC index reported about a 70.5% weighting to senior. So the BDC market here is a little more weighted to senior. Another thing we noticed is a tick up in equity holdings, which were up to near 12% compared to about 0.55% at the end of year-end 2011. So this has kind of shifted and replaced the subordinated debt holdings, which have gone down a little bit. I think this is just a little bit more favorable risk return in this space as compared to subordinated over the last few years. Next slide, and last but not least, returns for BDCs. Not the best performance picture here, but not overly surprising in one of the toughest market environments ever. Total returns are negative year-to-date through June 30th, despite a small rebound from earlier COVID-19 losses. The average open non-traded BDCs declined 2.33% year-to-date, and the closed BDCs are down 17.27% due to kind of losses and write-downs in legacy assets. By comparison, the S&P LSTA Leveraged Loan Index was down 4.61%. We talked a little bit about delinquency rates earlier in real estate, but another indication of continued issues is the default rate for leveraged loans. The default rate in the S&P LSTA Leveraged Loan Index is was up to 4.41% as of July 31st, which is more than twice the level from January and the highest level since 2010. And this is predicted to be up at 5 to 6% by year in 2020 and upwards of 8 to 9% in 2021. And within the index, the retail and oil and gas sectors have definitely broken default records in recent months. Retail hit 10% in July, and oil and gas reported a 31% default rate in July. And this is one of the main reasons why the worst performing BDC was actually the FS Energy and Power Fund, which is down 38% year to date. And on that note, that is the end of my prepared webinar here, and I'd like to thank you all so much for listening in. I know everyone's busy right now. I hope you and your families are safe and healthy, and we'll talk again next quarter, and have a great evening. Thank you.